How's everyone doing? How's the market doing? Better, good. I'm actually hearing this from a lot of people, that the market's actually starting to pick up a little bit. There's a lag between what you guys are saying and the data, right? Because you really start to see it once those contracts get signed. Until then, a lot of stuff, our offers are coming in, offers accepted, contracts out, stuff like that. So we're still up to January. And my goal, I know a lot of you guys here, right? A lot of familiar faces. You guys know me, we've been through hell and back in this market, right? It's been through a ringer. So I'm going to talk about some basic stuff. I was asked to talk about downtown, so I figured I'll break it up between some basic stuff for sellers, what sellers need to know, how I deal with market leverage, and how I figure out where the market is and which way it's going. Downtown is trailing the whole market in terms of performance, we're going to go into that. And then I got some historical stuff here. But look, we all know each other, so if anyone, and I'm happy to share this PowerPoint by the way, afterwards. If anyone has any questions during these slides, just holler out. Don't hold back. So let's go to the next slide, please, John. It's important. Some of you guys may have heard me talk about this, but it's important to talk about it. I was talking to Stephen about this before. We look at the market, and we've had like this progressive decline since 2014, 2015. Probably 2014, late 2014 was the luxury sector, kind of peaked out. 2015 was the broader market. And since then, we've been kind of progressively declining, right? 2016, 2017, 2018, 2019, here we are in 2020, progressively declining. And what has changed during those times is basically policies, right? So when I look at the market and I think of bids, asks, and spreads, right? It's all about bids, asks, and spreads. And I think of the market in 2013, 2014, 2015, let's put our cap and go back to time and place. The spreads between bid and ask were something like that, right? 2013, 2014, 2015, and sellers were getting 99, 100% of their asking price. It's just a crazy market. There was no inventory. And when I look at bids and spreads, bids and asks now, it's something like this, and it has been like this. I actually think mid-2019 was our bottom, actually, in my personal opinion. And those deals that were happening right around the rent regulations in mid-2019 and the mansion tax in 2019, I think those guys kind of hit the bottom. But we have the SALT tax deduction cap, that makes New York City less affordable, flat out. We had the mansion tax revamp, that kind of screwed all the numbers up. You guys see all the Q2, Q3, up 20% year over year, Q3 down 20% year over year. You're going to see that in all the charts. It kind of messed with the numbers, so you got to keep that in mind. Those rent regulations are a killer. That's by far the biggest thing that's impacting our market, the townhouse, multifamily market, the mixed-use market. Just the fact that investors are looking at this market and saying, Jesus Christ, Albany's just making all these policies that are making this market not investor-friendly, and they're making it more tenant-friendly. It doesn't make those guys bid more aggressively. It makes them bid more cautiously. And that's what's going on. I think the townhouse market right now, I'm a buyer. That market's getting killed right now. So I'm a contrarian. I think people ask me where the value play is. The luxury sector, the new development sector, the townhouse sector, some of those sectors are down hard right now. And if you can find a seller that needs to deal and needs to liquidate, that's how you make good deals. There's talk about pied-à-terre tax. You guys are hearing about this. It may happen, it may not, but just talking about it affects consumer behavior. Damage done, quite frankly, right? Even if they don't do it, I almost feel like that's almost impacted the market. It's crazy. And we also have a strong U.S. dollar policy. There's a lot of talk that we're hearing from people that do overseas deals, and they're saying they're just sitting on it waiting for the currency to kind of swing back the way, which is interesting. So they got money to put to work, but they're waiting on this. So that's that. So keep these things in the back of your head when you talk about why we are where we are. Let's go to the next slide, please. So let's just talk about some basics downtown, right? Sellers only care about pretty much two things: how much am I getting, how negotiable do I need to be, and how long is it going to take me to trade. And when I look at downtown, this is downtown, and about 96 days on market, so about half a listing agreement, something along those lines, right? And I look at this, a lot of these charts, if you consider what we've done in the last 10 years, let's just, for a second, 10 years, 2010, right? 2010, 2011, 2012, 2013, 2014, 2015, the market was improving. We peaked out. And then we came right back down. So if you're looking at price charts, I'll probably go something like this, something like that. If you're looking at any kind of chart where as you go higher, the market's weak, and as you go lower, the market's strong, it's going to look like that, like a cup, like a chalice, right? So I kind of see, I see this kind of thing. We're up over there, it went down over here, and now we're back up over here. What's refreshing is that we're off the highs. Okay, so in terms of days on market, time it takes to sell, give it 2 or 3 more months. If we breach those highs, this market's weak again. If we don't breach those highs, we'll know around March or April. We'll know.
Would the dip have been just because a lot of stuff comes off the market, a lot of stuff isn't available at that
This dip right here?
period? Yeah.
Seasonality. Typically be seasonality. Right? Seasonality does affect this. I would say the peak, this is about to go higher because you're going to get a lot of contracts that are about to get signed. First the stuff comes on, then the stuff goes to contract. When the stuff goes to contract, we count the days on market. So you can get a sense of like, all right, of those deals that are in contract and they were lucky enough to get a deal, how long did it take all those guys to get a deal done? So what happens in January is the stuff first comes on, right? The good stuff, the new stuff, and also the old sale stuff at a new price because they freshened it up, so to speak, right? February, March, April, May, that's when you see contract activity progressively increase, and that's where this number is going to either go up or down. So we gotta wait. We gotta wait, but it's very much seasonality. This is from list day one to contract signed, correct. And if you go off market and you try to mess around with it and you know, jiggle with those numbers, UrbanDigs won't let you do that. But if you change your unit number from 10A to A10, you guys are aware of this, right? You guys see this shit out there?
My agents never do that.
Yeah, I know. I mean, who's in charge of REBNY RLS here? Who's connected? Is anyone connected here? Who's the connected? Where are the connected people? No connected people? I mean, we just got to make it so agents can't change unit numbers. You know what I'm saying? It should be a static drop down in RLS. You go to this building, here's all the unit numbers, you pick your unit, and that's it. If it's not there, you add it in. But people are doing that to reset days on market.
It's fascinating that every year September is the top point, and then like January it drops.
Tends to be the seasonality, because right after September, because the peak of contract activity is right after September, it goes right down the hill after Labor Day. Right. Okay, so let's go to the next slide, and let's compare this to Manhattan. Right, so Manhattan's 92. All right, downtown's 96. I mean, I look at this, it's almost like the Upper East Side, Upper West Side. The Upper East Side, Upper West Side tracks broader Manhattan, right, typically. I kind of look at this and I'm like, all right, you know, here's Financial District, here's Manhattan. It seems like the first 5 years of this chart, Financial District was outperforming Manhattan and has better days on market, or lower days on market, so it was selling quicker, right? And somewhere around 2017, we switched. And it seems like now it's kind of underperforming. So slight underperformance to the broader market. I just wanted to point that out. Okay, up 4.3% year over year. So days on market is still taking sellers longer time to trade. Next slide, please. So now when you break down days on market, this is where things get, you know, guys, you know, I don't need to tell you this. The market is fragmented, right? And every single sector, price points, bed count, property type, is doing their own kind of thing. So when I look at days on market and I break it down, I just kind of pick 5 neighborhoods. I pick Greenwich, West Village, Soho, Tribeca, Financial District. So I can give you kind of extremes. You know, days on market in Greenwich Village is 83. You know, 82 in Soho, 94 in West Village, and then look at Tribeca and look at Financial District. I imagine Tribeca's getting hit because it has a lot of higher end stuff. Yeah, and whatever's comprising the higher end stuff, maybe some new developments there. And we all know that that's the 2 sectors getting killed right now.
And those agents are suffering.
Look, I can't wait for that luxury sector to start. Next slide, please. Yes.
Will you share us the slides in New York today?
Yes, this will be shared with you guys so you can blast it out and everyone can see what's going on. No problem. Listing discount. How negotiable do sellers need to be, right? So sellers are going on the market and it's, all right, what do I need to, you know, how much do I got to think about going down here? And again, think about that chalice shaped chart, right? You guys see it's like a cup, right? That's kind of, this market is really kind of back. We've regressed 8-9 years. We're back 9 years ago, right? So back to 2011 levels. Sellers are going down about 6%. And again, here's the glory days, 2013, 14, 15, where sellers were getting 99, 100% of their asking price. Not anymore, unless you're pricing right.
This is from last published price?
No.
From first published price?
This is from original ask. So one reason why I have no hair, right? I like to stick this in there at all times. Is I actually, for those of you that knew me back in 2009, 2010, 2000, remember I used to have a ticker on UrbanDigs, the UrbanDigs ticker. It used to show real-time updates. I used to actually go through every single status change in RLS for a year and a half, 2 years. Yeah, exactly. Hair. You can see the hair falling out.
Well, mine just fell out.
Explaining to my engineers why in this scenario we got to do this, in this scenario we got to do that. We basically cleanse all the bad poisonous crap in RLS so that we could do stats like this. Otherwise we would have had to do from last ask. From last ask is this easy way out. It's like saying, all right, there's a bunch of shit, sorry for my language, a bunch of crap in RLS. I can't figure it out, so we'll just take the last published price and do it. I don't like that because if you're priced at $1 million and you're on the market for 5 months, and then you do a price cut to 900, and then you get 900, that will say you just sold at full ask. Whereas UrbanDigs will say you're down 10%. So this is from last ask. Sellers are negotiating around 6%. Better for a narrative for the conversation. And again, this is a sell side chart. So we started out with the basics for sellers, and that was days on market and listing discount.
This is from original price.
Original
price.
listing price.
You just said last ask.
I'm sorry.
You bet.
6% from
Yeah,
the
I just
original
wanna
listing
make that
price. I'm
clear.
sorry. Yeah, getting a little tangled.
To the same, yeah.
Tangled up in blue over here. So.
Yeah, I mean, December I saw last ask to closing price was about 4.7%, so it's,
Interesting. Okay.
yeah, that was on our, you know.
And this is down from 8. So if there's a green shoot, I mean, we can talk about some green shoots, right? Is look, we're off our lows in terms of this. So that's something to keep an eye on, right? Are we stabilizing on a new level? Are we getting better? Again, I happen to think mid-2019 was the peak of buy-side leverage and getting the best deals so far. But we'll see. Next chart.
I think the chart probably need a definition on how you compare to the original listed price, because a lot of buyer, they will just look at, oh, the average listing discount is this and that, and there's this put in this offer, and this based on.
Yeah, I think the broker, it's a good question. I think the
Yeah.
broker needs to educate their client accordingly. If they're not, that's a possibility. I mean, if they see a chart like this, they're just gonna automatically put every single listing into a bucket. And in the reality, in the world that we live in, the market doesn't operate in a vacuum. Some places are price right. Some places are gonna get action and they're gonna trade right at the ask, and that 6% doesn't mean anything. Some places are overpriced by 25%. So it's really just the job of the broker to kind of identify that target unit and see how it all relates. This is really more for overall, general, broader trends to tell the client, whether it's buyer or seller, here's the changes in the overall market, and here's where the leverage is not in your favor, and here's the stats that show that. You know what I'm saying? A lot of brokers do not educate their clients properly on that kind of stuff. Very interesting. When, again, comparison to Manhattan, Manhattan's at 5.7, downtown's at 6%. It's just like days on market. It's just a slight underperformer. And when you look at it over time, it's kind of the same story. It was a better overperformer, and then we kind of switched. Now it's a slight underperformer. Looks like that chalice again. A lot of charts look like that. Next chart. When I break down negotiability by neighborhoods, you get a completely different story. This is why you got to go. Again, I don't care if you use UrbanDigs or your own systems. I really don't. If you guys got your own systems that you use for this stuff, great. As long as you have the conversations.
I care.
Okay, well, John cares. John wants to go to UrbanDigs. But you know, Financial District, they're negotiating 11%. Tribeca, they're negotiating 10%, and Greenwich Village, they're negotiating 5%. This is all price points. If you break this down into other price points, you're going to see different stories. So like if you're going to talk to a client intelligently in the Tribeca new development market, you know, I can imagine what that listing discount's going to be, right? So this is where hyper-local knowledge is important.
The longer days on the market, the more negotiability.
Of course, and there's a direct correlation there between pricing right, longer days on the market, and negotiability. Next slide, please. Okay, we're going to go now to the market pulse and market leverage. This is kind of like how I'm an expert in the market. It's the simplest thing in the world. If you go to my chart room, you're going to see these charts at the top of every single chart room line. We give you the ability to go market-wide, resale, new development. Sorry, I should have taken Sotheby's tool out. Take that away, all right? That's not there for you guys. That's a good way for you guys to know in case you guys need proprietary stuff. We do that for you guys, okay? We did that for Sotheby's, we can do it for anyone else, but that's not there. Market-wide, resale, new development, and I just did downtown, right? So this is showing me supply downtown, pending sales downtown, market pulse downtown. What is the market?
How are you defining downtown, by the way?
I believe
Below 14th Street.
I believe it's 14th Street.
Oh, really?
Yeah.
So not Chelsea, not Gramercy.
No.
Not Chelsea, not Gramercy.
No, not in our downtown. It isn't. Okay. So supply 403, pending sales 533, market pulse 38. Turn that to a percentage, 38%. What does it mean? 533 deals that are in contract, your measure of demand, represents 38% of total inventory. Does that make sense? It's a ratio of demand to supply. So 533 divided by, or 1403 divided by 533 gets this number. That makes sense to you guys? The point of it all, it's basically measuring supply and demand for you so that you could just look at a number, and if it goes up, the market's getting better. If it goes down, the market's getting worse. It's just that simple. So like by looking at that market pulse 0.38, I could see two things. I could see which way downtown's going. I could also see how is downtown compared to other markets. Is it doing better? Is it doing worse? Because if the market's doing better, that number is going to be higher. If I looked at downtown 10 million plus, it's probably 0.15. If I look at downtown new development, it's probably 0.14. You know what I'm saying? So this is how I know which way the market's trending. It's all relative. So like I take 2 seconds out of my life, I look at this number, I break down some things, and I know, all right, well this number was at 35 2 weeks ago, so we're slightly improving, right? It's all relational. So let's go to the chart and show you what market pulse is. So when I look downtown, here's the market pulse chart over time. right? And what we did is we took every historical point from 2020 down to 2011, I think it's 9 years, and we stacked them in an Excel file, and we took the median, and we defined a threshold. You guys see this? And above it is a seller's market, and below it is a buyer's market. So when you look at this chart, and you look at the time scale at the bottom, and you know when it goes higher, it's a strong market. Does this represent what you think happened in the market, yes or no? Okay, this is such a spot-on thing, right? It's such a spot-on thing, and you can do this for any sector of the market. So like when I show my sellers, well, am I getting any leverage in this sector of the market? I can just go to a chart like this and kind of show them, like, look where you're down from at this level, right? Now, just to give you perspective, that's one, right? What that means is, imagine 1,400 listings for sale, 1,400 listings in contract. There's a one-to-one relationship. Whereas now it's 1,400 listings for sale, only 533 are in contract. Much different. Same amount of inventory, demand way, way, way down. That's why the number is much lower.
Why did you determine 0.6 is the
We look at we take every single data point, every day, every single day this calculates a new data point. We took every single day for the last 9 years, put it in an Excel file, and we looked at the median of all those numbers.
Okay.
And that's what dictates. Now, if you
So between
change
2011 and 2020.
yeah, it's real time. This updates every day. If you change the parameters, Stephen, and you go to different sectors, that threshold will change.
Okay.
So it changes based on the sector you're looking at the time. Make sense?
Yes.
It's just a great way of understanding which way the market's going in a visual way. So if there's one takeaway, this is your indicator to figure out whether or not the market's getting better or worse.
So if I use this tool for just 2018 to 2020, which we know were not sellers' markets, I'd be able to determine which point in that 2-year spread was more favorable versus less favorable to sellers, even though they both suffer for sellers.
You can go to the chart, highlight over your start point in this chart, click it, drag it over your end point, and the chart will just show what you just covered, and you can kind of show that shortened sector. You got to play around with it, but yes. Okay, good question.
So again, the takeaway on the number one is there's an equivalency between supply and your number of units.
Just to give you guys an idea, generally at all times, supply is usually higher than pending sales.
Right.
Usually at all times. Like if you're trying to figure out what a balance is, usually 0.5, 0.6, 0.7 tends to be where the lines are. As you get above that, it gets more of a seller's market, right? And when I think about the peak of the market, usually it approaches around 1. So if it ever gets near 1, this market should be on fire, right? That's what you guys need to know. But it's all relative. Looking at this chart should show you the decline from there. How are market conditions here? How are market conditions here? And does this chart represent the changes over time? And it does. It really does. It's a good chart to get down. Let's go to the next one. So market pulse. I decided, I took these 5 neighborhoods. I'm like, all right, you know what? Let me show these guys what the market pulse is for all these neighborhoods, just to show you that I'm not crazy here, even though you may think I'm still crazy. Downtown as a whole is 0.38, but when we break it down, Greenwich Village 0.77. Right? What we just talking about? Soho is 0.62, West Village 0.4, Tribeca 0.26, and Financial District 0.14. That's before putting filters on it. That's just as a whole. Just to show you how hyper-local Manhattan is. Right? Every sector of this market, every building is its own market, but every sector is doing its own thing. Next chart, John. So we're going to get some historical stuff here, just to kind of give you guys an idea of where I think we are. This is pending sales. Your measure of demand. You see that little peak? You see a little boop straight up right there? You guys see that? I think that's what you're experiencing right now. You guys, a few people were talking about it, you said in the last month, right? And I saw that pop, and that was interesting. Usually that doesn't happen so soon. That usually starts happening February, March, April. It starts to kind of progressively rise. It doesn't really pop like that. So let's keep an eye on that. But when I look at pending sales, again, your real-time, updated every day measure of demand, and I look at where we peaked out, right, this is not prices. Prices are not real-time. Prices are lagging. This is real-time. And it peaked out in June 2015, in line with where we're saying that 2015 is the market. And I look at the bottom, pending sales really did hit a 51% decline, and that was right around mid-2019. Again, you guys starting to see why I start to think that mid-2019, I look at the numbers. And I've been doing this a long time. It's just kind of a natural thing now. 50% decline is a notable decline in pending sales. It just took, usually the down cycles that Manhattan has are like fast, furious, fall off a cliff, and then we come back after a year. This down cycle has been totally different. It's been a death by 1,000 cuts, and it's just been a slow bleed, right? Would you guys agree with that? Mm-hmm. And it's just like everyone's freaking tired. They're tired of it, and it's just nothing we can do at the end of the day, because the spreads are too wide. We're trying to get them together. Hopefully buyers are getting it, and sellers are starting to come down. But this shows you what's going on. It's downtown. Let's look at the next chart. Okay, price per square foot downtown. You know, when I look at a chart like this, I wonder if the market even went down at all. Really. See this, guys, right here? That's your mansion tax. That was that whole thing. Try to do something like that. See what I'm saying? You know what I'm saying? Like that, try to whenever you have a mansion tax, if you have a policy change that skews the numbers, and that really did screw the numbers, again, you have to be aware of this. And you look at a chart and think, oh my God, the market just popped. No, it didn't. This was all demand that was pulled forward and consolidated into a small sector. These are all high-end deals, and I'll show you in a second. I'll show you a sales volume chart. So you really want to kind of visualize it more like that. And if you visualize it more like that, coming off our lows a little bit. Now, like I look at this, and naturally I kind of go across, and I'm like, all right, well, where's the downturn? It's hard to see. You know, if you ask me, this is downtown, but if you ask me Manhattan-wide how much I think that we are down from 2015 to now, I would say something like 12 to 15% max. Maybe 10 to 12% or something like that. We're down 3 or 4% from last year. I think the hits happen. It's been a slow hit. We're kind of bouncing along the bottom right now. We're not really just shifting lower. And a lot of the charts won't show it. A lot of the charts will show different things. John, go to the next chart, which should show resale. Okay. Resale shows it. So we strip out new development, and we get a little better measure. Now you look back to 2015, and you look to the trough, you got about a 16% decline in the trough. I mean, this is like the only way you can kind of see it, but it doesn't look like any kind of a crash. It's just a slow, progressive kind of decline for 4 or 5 years that's been going on. All right? And again, it looks like we're bouncing a little bit off the bottom. There's green shoots. It looks like we're bouncing a little bit. We're still down year over year, but we're coming off the bottom a little bit. Now, let's look at new development. When I look at new development, and I look at peak to trough, that's a 30% decline in new development. Right? So going back to the original conversation, if you ask me where, I'm sorry, Brian, if you ask me where I think the market, the broader market is from peak to trough, somewhere between 10 and 15%. Now, super luxury, 10 million plus. I can't quantify this, I'm giving you an estimate. Super luxury, I'm hearing some places between 30 and 40% from late 2014 to now. The super luxury market got destroyed.
This is closing prices,
This
not,
is closing,
not listing
pure
prices.
closing data.
Okay.
Pure closing data. The data is what the data is, you know what I'm saying? What makes these things volatile? All right, why is this like that? There was 1 or 2 months where a bunch of new developments just happened to close 60 units that were priced between 4 million and 8 million. And that's now showing it in the data. You know what I'm saying? That's why these things happen. That's just it.
How do we know which of this, is there a way to know which of this is from the change in the mix and which is the change in the actual
Only
prices?
thing you do is do a search. If you go to my site, you can do a search. You can do a downtown search, closed, new development only, and there's a time chart. There's a calendar. You can literally pick time frames, and you can say, show me these months. You know, go to this chart, figure out what these months are, and then go to that time scale in UrbanDigs and say, only show me April and May of 2018 closings, new development, financial district, and it'll show you those. It'll show you everything that's populating this, and then you can do a CMA report and see what the numbers are. Right? We have moving averages, connecting to our 6-day moving averages so that we kind of try to smooth things out. It's even more volatile without it. Okay. But if you look overall, it's about a 30% decline. Next chart. Okay. New development sales volume. Number of closings for new development. You see this? That's the mansion tax. Okay. In general, there's a bunch of new developments closing, really. If you just combine the last 5-6 months, that's a decent number. It's not down here, it's nothing like that. I mean, this is a notable number of sales. So I think this is what's bullying the price trends a little bit. When we looked at resale, when we looked at that resale chart, it didn't have this stuff. Right? So that's why resale showed a little more. When we looked at the overall market, it showed a little pop. I think there's a higher concentration of new development closings in the financial district that have been coming through that have been artificially kind of putting the numbers on.
Are you able to do a statistic where you determine the percentage of closings that are new development versus resale? So that if you look back to the height of the market, 2014, 2015, you could see that the bulk of the
I don't have a chart for
closings
that.
were resale and they weren't new development.
Yeah, it's a
We
great.
can pull that statistic, we just don't have it in.
I would have to ask my engineer for a raw query poll.
The reason why a lot of our agents feel it's so slow is because if you're getting a larger percentage that are new development, there's just a select group of people who are doing new development deals.
I agree.
And there's a whole host of people who just sort of do co-ops and condos and a resale. And if those are down in terms of the number of transactions, I think that's why people feel the lethargic nature, which is in contradiction to the data that you.
Send me an email on that.
That's the market.
Something I can forward to my team and tell me the details of the chart that you would like to see, and let me see if I can stash it in there.
I also think, except for the mansion tax mixture, part of the reason for that going up is I bet you'll find that the discount off of original ask on those new devs is much higher than what you're seeing.
I guarantee it, and what's difficult is that we can't track concessions.
Right.
So I think what I'm hearing is that developers are negotiating 10 to 12% on price and another 5 to 10% on concessions, if you can get it. If the brokers are smart enough to understand what's going on.
And they weren't negotiating price at all in those earlier days, but now they are.
Yes.
It's a big difference.
Yeah.
Transfer taxes become a given.
Yeah. Yeah.
That's true.
Yeah. Good points. So if we just kind of wrap everything up here, I mean, there's a lot of stuff and some mixed signals, but some conclusions would look something like this. When dissected, downtown's a tale of two sectors. You really got the West Village, Greenwich Village, Soho markets overperforming, Tribeca, FiDi underperforming. The results is muted market price trends. Analysis should always go local and stay local. This was a policy-driven reset. I don't think this was a cycle, or is a cycle. I think this is a reset. We were here. A bunch of policies changed, and now we're here. I mean, I don't see what the stimulus is going to be to kind of push us to a next growth phase, like longer term. I kind of think we're going to be at this level, bouncing along. We may rise 3%, 4% year over year, you know, but that's more because last year was so deflated, and now this year's starting to normalize, and we just kind of popped up a little bit. I think we're going to bounce along this bottom in this kind of channel, and I think we're going to be here for a year or two. I really do. I hate to say it. Hopefully, they don't pass more policies that affect us. There's talk that the rent regulations might be scaled back. Do any of you guys know anything about this or no? Just what you heard.
There was talk about that, and the last word I heard was that that idea is now being pulled back a little bit.
Oh. So yeah, there's other policies being discussed as well. So it seems like we're under attack for some reason. Nothing is crashing, I guess, unless we're looking at new developments which already crashed. It's not crashing. It's not in the process of crashing. It's already down. Everything's already, the hit happened. Everything's priced in. That's what buyers need to understand. They're priced in. It's still a transactional market. Pricing is key. And I have one more slide of conclusions here. Prospects for 2020. I mean, look, again, I don't think this market's running away from anyone. I really don't. I think we're kind of down here. We're at a new normal. We've reset until policies start changing. I mean, the stock market, look what the stock market has done over the last 4 years. I mean, think about that for a second. That to me is scary, because if that stock market crashes 10% finally, right when we're starting to pick up a little bit, that's going to kill us again. You know what I'm saying? It's going to kill perceptions. Like, all of this has happened while the stock market has done this and the economy has done this. What if the economy slows down? What if the stock market has a normal 10% healthy correction back? I mean, it's just way too juiced right now. All that stuff is just manipulated, right? So I think it's a good time to buy in the sense that the hit has happened, and I think it's a very good time to buy in sectors like townhouse and new development, especially. New dev supply pipeline. Think about this. Right now, we have a supply issue in development, but that's a result of 4 or 5 years ago decisions, right? These developments don't go up overnight. So in 2013, 2014, 2015, there was an inventory constrained market. We had no supply. Developers made decisions then that are now being marketed in 2018, 19, and 20. And a lot of these buildings being marketed in a much different market, right? And now there's an oversupply problem. Is there a lot of people building right now, new stuff right now? No, okay, it's been like that for a year and a half. Developers have to slow down and like, well, let's take it easy here, let's just do what we got. Wait till the market kind of corrects, figure out what's going on. So 2020 is going to be a problem, 2021 is going to be a problem, but what happens in 22, 23, 24, and we reach that point where the supply is starting to normalize? Maybe there's some bankruptcies, maybe there's not, maybe they turn rental, who knows, not co-op, rental. But at some point we could be setting ourselves up for a potential new development constraint market, but that's 3 years, 4 years down the road. So I'm just talking about what could be ahead. Usually people start pricing stuff like that in when it's a year away, so we're still far off from that. But it's just an interesting thought, a thought experiment. Policy changes, softening of rent regulations, paid fair tax will go away, and again, macroeconomic issues, equity markets, and US dollar. That's the two things we're looking at. So I hope this gave you guys a little update on what's going on downtown. Is there any questions for us? Otherwise, I'll get out of here and let you guys do your thing.
Very informative, though.
Cool. All right, thanks, guys. You can always email us if you need anything.
I have a question. When you drill down to try to get a little more micro, is there an indicator of like when the data set gets a little squirrely? Is there like an N shown anywhere?
You mean like just
Like
in
if I
case the
want to look at
sample size gets
bedrooms under $1 million and try
Yeah, so when you hover over the chart, it'll basically give you a count.
Yeah,
And you'll
okay.
see like,
You'll see, like, it gets down to a
the
certain
chart
level.
itself will be squirrely, and then
Right.
you'll see, oh, I'm looking at
Yeah.
Five
Yeah.
sales, yeah.
if you're tracking townhouse sales in Tribeca, for instance,
Right.
it's like a weird.
Yeah, you gotta understand, agents want everything too, you know? Agents want, like, show me the pre-war, full-time doorman, pet-friendly, with a courtyard, buildings, and this, only this
Within 3
6-block
blocks.
radius
Right.
of this area, because my client's in that sector, and everything else doesn't matter. And I'm like, there's nothing there to show you.
Right.
Yeah, so.
I could draw you pictures of this.
Yeah, good. Thanks, guys. Have a great day.